If you've ever wondered how homes get their price tags, stick around and watch this video because I'm breaking down the housing market and revealing why some homes skyrocket in value and others plummet. We're going to dive into the three biggest influencers of home values: supply and demand, interest rates, and the economy. By the end, you will have a solid grasp of what makes the housing market tick. So don't forget to hit the subscribe button for more content like this. First off is supply and demand. Let's talk about these two most basic economic ideas. These are two forces that make the world of buying and selling work. Supply is about how much of something is available. So let's say a city has 10 homes for sale. That is the supply. Demand is really just a fancy word for people who want something. If a lot of people want to buy a home in that city, we say the demand for homes is high. Now, how do supply and demand work together? Let's imagine that there are 10 homes for sale, which is going to be the supply. And then there are 100 people who want to buy those homes. That's the demand. And we would just say that there would be a high demand, but not much supply, which would usually mean that the price of something would go up. Why? Well, because people really want it and they're willing to pay more to get it. When it comes to houses, the home seller can take whatever offer they want on their home. It's really just their decision. So typically, they would like to take the highest offer for their home. And when multiple people want a home and the highest bid is taken, then other sellers in the area are thinking, hey, my house must be worth that too. So buyers are going to see that and they're going to realize other people are willing to pay a high price for the same home that they want. This can cause buyers to compete with each other, and the price tends to go higher because of that. So most of that, honestly, is just emotional. But the thing is that those emotions affect the housing market in a real way. Now let's switch things up and let's take a look at what happens when things are reversed. Instead, let's say the same city now has 100 homes for sale. That's going to be the supply. And there are 10 people who want to buy those homes, the demand. That means that the supply is going to be high, but the demand is low. Now, home sellers are the ones that are trying to compete for the buyers to be happy. And this would be a market that is the opposite of the first one we talked about, where buyers were trying to pay higher prices for homes. But now that there is a high supply and low demand, it's the sellers who are trying to compete to make the buyers happy. So supply and demand is the biggest influencer in the price tag of something. And when there's more of something than people want, which is high supply and low demand, price tends to go down. But when there's less of something that a lot of people want, which is low supply and high demand, then the price goes up. And that's how stores and online shops and of course the housing market decides on, how much to charge for what you're going to buy. Now let's look at some other things that influence the price of homes, and one of those is going to be interest rates. At the end of the day, regardless of the price tag of a home, people still have a monthly bill or what's called a mortgage. And most people cannot just ask their rich family member for $1,000,000 to buy a home. So the amount someone can actually pay every single month will really be a determining factor whether they can buy a home or not. In borrowing this money, it's not free. So the cost of borrowing that money comes from interest a mortgage lender is going to charge you. And this interest rate can really add up to a lot over time. Here's an example. If you borrow $500,000 from a bank to buy a home, you will also have to pay the bank interest. And the total amount of years that you're set up to pay your loan off, let's just say it's 30 years. So let's say you have an interest rate of 5% because you are paying that 5% interest over the total loan every single year for those 30 years. What happens is you don't just pay back the 500,000. You actually pay that same 500,000 plus $466,278 in interest. So that $500,000 house actually cost you $966,278 when you pay it over the course of 30 years. And that's just the cost of the loan. It does not take into account taxes, insurance, and the overall home ownership costs. So this is not me saying that buying a home is good or bad. It's just the math that goes into borrowing money. And why did we need to go into all those numbers? Here's why. Because it greatly influences how much of a home people can afford. Let's take the exact same scenario, only we're going to say the interest rate is 7% instead of 5%. That same $500,000 home now costs $500,000 plus $697,544 in interest. And now in scenario one, when you took out a loan for 5%, Your payment every single month for that house was $2,684. Now let's take the second scenario. You went to go buy that same house for 7%. Your monthly payment would be $3,326. And your total mortgage paid would have been $1,197,544. That means that when interest rates went up just 2%, that same exact house now became $642 per month more expensive. And over the course of the 30 years, you're going to pay over $230,000 more dollars. Same house, different cost of borrowing money. Most people cannot just come up with an extra $642 every single month just because interest rates went up. See, typically they just have to qualify for a smaller loan amount to afford a home. So let's say this is you. That means that if you want to keep the same monthly payment and interest rates go up from 5% to 7%, well, you can now only afford a home that's $400,000, but you're going to still have the same monthly payment as if you would have had that $500,000 home when interest rates were 2% lower. So long story short, when interest rates go up, the ability to afford a home goes down. So even if a lot of people want homes, it doesn't necessarily mean that they can afford to get the one they want. So now that we've covered interest rates, let's shift our focus to the broader economy and its impact on home values. Things like how many people have jobs, how those jobs are paying, and really the value of the American dollar have a big impact on housing prices. When employment rates are high and a lot of people are working, incomes go up. So lots of people working, making lots of money, meaning lots of people can afford to buy homes. But when more people can afford homes, then typically that means demand goes up. And if you remember what we talked about in the beginning of this video, when demand grows, then the amount of supply is going to determine if buyers are going to need to compete for houses or if sellers are going to need to compete to get buyers. The areas that have high employment rates and high salaries tend to have higher home prices. For example, in the San Francisco Bay Area, many people in the tech industry are paying extraordinarily high prices for homes. A home in Cupertino, near the heart of Silicon Valley, with 2 bedrooms and 2 bathrooms, recently sold for $3.6 million. Homes just 20 minutes away from the Silicon Valley are selling between $2 and $3 million, where those same exact homes would probably be about $400,000, maybe $500,000 in most of the rest of the country. And that tells you the demand for homes by people that make a lot of money are very high in that area. And the supply of those homes is really low. Now, the value of the dollar is also very important. When the value of the dollar goes down through inflation, it takes more dollars to buy the same product. Now, when new homes need to be built and the cost of construction is high because the building materials are now more expensive because of inflation, it can affect the number of new homes that are built. So again, that's going to affect supply. So in areas that have a high demand for houses, and if new houses aren't being built to keep up with that high demand, that's going to mean that the prices of those homes are also probably going to be higher as well. Now, that also works in reverse. So if the cost to build a home goes down and the economy isn't doing well, we can have overbuilding and too many homes. In that case, we see housing prices slow or even decrease and possibly crash in some markets. Now take a look at this graph. It shows how much demand there were for homes around the 2008 period. Now, compared to the supply, we had way more supply, so there were tons more homes available for sale than there were people who wanted to buy. And of course, we had that financial collapse, but that alone doesn't just mean values decline. The fact that we overbuilt homes and had a lot of homes available for purchase then gave a lot of people the ability to buy a new home and just walk away from their current home and stop paying their mortgage. There were tons of houses for people to be able to buy. Now, in a market where there are not many homes available, this would not allow for the same thing to happen very easily. So whether you're a homeowner, a potential buyer, or just curious about real estate, understanding these factors is key. They shape the market, they influence prices, and really they determine what you can expect to pay for your dream home. If you found this video helpful, make sure that you like and subscribe to the channel and hit the notification bell for more insights into the housing market. Thanks for watching. See you next time.